The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Kerry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed, it's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. A lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it. You issue bonds to cover the borrowing. And if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans. That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, etc. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So Keynes said, well, if everyday people won't do it, the government must. The government can borrow. The government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein on me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one, on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. The number one question, because everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. It's like, hey, if I used to fill up my Ford F-150 truck for $50 and now it's $125, A, you get it. It's right in your face. And B, that's $75 that you don't have to take your spouse out to dinner, buy a new jacket or whatever. So there's kind of demand destruction at the same time you're spending more money on the one thing you can't do without. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming late this year, early next year. Now I say, we're in a recession. I mean, it's not coming, we're in it. And there's data. I never make statements like that, Brian, without supporting it. We know that The standard definition of a recession is 2 consecutive quarters of declining GDP. There are a few more bells and whistles having to do with unemployment and a few other things, but that's the rule of thumb. So based on that, based on the best available estimate for a second quarter, likely to be accurate, we're in a recession today. Now, it's not severe, but that's like saying I'm in bed with pneumonia, but I'm not dying. Well, okay, but we're in a recession right now. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, buy Netflix or whatever. There's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So you got to reverse engineer the 27-year-olds from Bangladesh who don't get out much. They're the ones really writing these algorithms. Brilliant engineers, but you'd have to show them around Wall Street. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on.
All right, so you're expecting a major correction in stock markets on the back of a recession.
I'm not alone. I mean that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3 in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts.
And that would mean like S&P coming off another 20-30%?
Yes. And again, you have to remind people. 1929, the stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So we're down. Nasdaq's down. Bounced back a little bit in recent days. Down close to 30%. Down. The S&P down over 20%. We're in bear market territory. But that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect.
Talk to me about inflation, because I was looking at some of the inflation numbers, and you have to go back to the 80s to see anything that's approaching double digit. I remember being just a kid hearing about double digit inflation. I could kind of remember the gas pumps, the lines at the gas. It's like a distant memory of me in the 70s. But how do you talk to, younger people these days about what inflation is or it means? Because I don't think people really grasp what it actually means to your savings or to the economy in even a medium term.
Well, that's exactly right, Brian. And if you, you're a little younger than I am, but I lived through it. I started my career in banking in 1976, and I remember my wife and I used to kid each other. She was in advertising, I was in banking, and the inflation was so bad, you'd get a raise every 4 or 5 months, and you didn't have to ask. They would just give it to you because they knew that you were going to quit if they didn't keep up. So she would get a raise, and she was making more than I was at the time. So we'd go out to dinner, and then I would get a raise, and I was making more than she was. So we would just tease each other about that. But that's how it was. And the psychology was, if you needed a TV set or refrigerator, or new car, or whatever, you say, I better buy it now, because the price is going to be higher. If I wait a month or 2 months, the price is going to run away from me. So it had huge behavioral effects. Of course, gold was, going to the moon. There was a lot going on at the time. But Brian, you're right when you say, we're putting up inflation numbers today that are the highest in 40 years. That is correct. But I remind people, the inflation in 1981 was the end of a 10-year period of inflation. That was when Volcker finally got it under control. But you go back to 80, 70, well, between 77 and 81, so that 5-year period, the dollar lost 50% of its purchasing power, not 15, 50. So the question is this the beginning of an inflationary surge where it's going to get even worse and it is going to last 5 years? Or is it different than that? But keep that in mind, because the situation we're in today is very different from the 1970s, and I'll explain why. But well, let's explain why right now. Because in the 70s, it was triggered from the supply side with first the Arab oil embargo in 1973 as a result of the 1973 Arab-Israeli war, and then the price tripled, but it went from like $2 to $6. Okay, but percentage terms, that's a huge jump, but it was still $6. And then it got to 12. And then in 1979, you had a second oil embargo because of Iran and the Ayatollah and the revolution and the hostages and all that. And then it went from kind of 12 to 20. So oil went up by a factor of 10 in the course of the late 70s because there's two different embargoes. So that's coming from the supply side. But what happened was, the other source of inflation is on the demand side. So you have what's called cost push inflation. That's where supply is choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. But the demand side is much more psychological. That's called demand pull inflation. That's when consumers behave the way I described, and as I say, I lived through the 70s, where hey, I better buy it today, I better buy it now. You're pulling all this demand forward and bidding up prices because you're worried that it's going to get even worse. So as that applies to today, we are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor, and of course they're related. It's like, here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food, you got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation. We're not quite at the stage where it's demand pull. We're not quite at the stage where individual consumers are behaving the way I described in the 1970s, saying, "Hey, better spend the money fast because it's losing value." So we're in a depression right now. It will last for a long period of time. But a lot of people get confused, and one can understand why, about the difference between a recession and a depression.
Yeah.
Most mainstream economists, they don't like what I call the D word. They don't talk about depressions. They talk about recession. So a recession is conventionally defined as 2 or more consecutive quarters of declining GDP. And this would be the first back-to-back recession since 1980, 1981. So you have a recession, you come out of it, and then you go right back down into recession. So that's technical recessions. Depressions are different. And a lot of people think, well, if a recession is 2 quarters of declining GDP and a depression is worse, well, a depression must mean 10 quarters of declining GDP, as if it's a really long recession. And that's not the definition. The depression means depressed growth. Growth is depressed relative to trend, relative to potential. So you can actually have growth in a depression, but the point is the growth is too weak. And so this is what we're in. We had... the third quarter, when you went down that sharply, you were going to come back pretty steeply. That's natural. But we didn't come all the way back. People say, well, okay, you went down 31% and you went back up 33%. So aren't you back where you started? And of course, the answer is no, because you're applying the 33% to a smaller base. So if you normalize, let's say 2019 is 100% of 2019 output. You go down 5%, and then you go down 31%. Well, now you're around 65% of the prior output. Well, if 65 is the new base and you go up 33, that adds 21 or 22, but you're only back to 87 because you're working off a smaller base. Even if you have, in my example, 10% growth in the fourth quarter of 2020, it's 10% of 87, so add on 8 more. You're only back to 95. So a simple way to understand it, you fall into a 50-foot hole, you climb out 20 feet. Well, that's good climbing, but you're still in the hole. You're not back to where you started. But a better comparison is maybe Japan. I would say Japan has been in depression since 1990.
Yeah.
Now, it doesn't mean, now they had growth and recessions and growth and recessions. You can have 2 or more recessions in a depression with periodic growth. But the point is, you never get back to the old potential. I mean, good example, the Japanese stock index, the Nikkei index, in New Year's Eve 1989, it was 40,000. Today, 30 years later, it's about 28,000. But okay, it came off the bottom, but it never made it back to the prior high.
It'll never be.
Oh, I think that's right. It may never be. And another example, in October 1929, the United States stock market crashed, a very famous crash, but it lasted for 3 years. And when it bottomed in 1932, it was down 89.2%, almost 90%. That's what a stock market crash looks like. But then you ask people the next question and say, well, when did it get back to the 1929 high? How long did that take? The answer is 1954. It took 25 years to get back to where. Now, it doesn't mean you couldn't make money in the meantime. You could have bought the low in 1932 and made money in 1933. But that's what depressions look like. That's the kind of thing we're in. This will be intergenerational. The effects of this will last for not 30 months, but 30 years. Wow. And there's very good evidence to back that up. There was a group, it was an economist at the Federal Reserve Bank of San Francisco and 2 academic economists. And they looked at all of the pandemics in the last 650 years, going back to the Black Death. I often criticize economists because their time series are too short. They say they're doing correlations and regressions. I was like, well, no, we need a much bigger time series. Well, 650 years is good enough. But they went back to the 1350s, to the Black Death, and they looked at every pandemic in which 100,000 or more people died. The fatalities were 100,000 or more. Of course, the 2 worst were the Black Death, the plague in the 1350s, and the Spanish flu around 1918, 1919. The Black Death was about 75 million dead, they estimate, and the Spanish flu was 100 million dead. And then after that, there were several where there were 2 million fatalities and some fewer. They were using 100,000. Well, there were only 15 pandemics in the 650 years where 100,000 or more died. COVID-19, by the way, is going to end up being 3rd on the list. Right now, it's 5th, but we have over 1.8 million fatalities, but it's not under control. So you can see that number is going to go past 2 million. It'll pass the Asian flu, and there was one other influenza in the late 19th century. So it's going to be 3rd on the list. But what they asked themselves, because they're economists, not doctors, and they said, well, how long did it take these economies to normalize following these extreme pandemics? And the answer is, on average, 35 years, not 35 months. And just to kind of give a concrete example of that. So I grew up in the 1950s, 1960s. It was a very prosperous time in the United States. I did not live through the Great Depression, but my parents did. And my grandparents did. So I was raised with a sort of depression mentality, even though I didn't live through it. And when we were little kids, 9 years old, my parents would send us that. We'd take our wagons and go door to door and collect tin cans and newspapers. And we weren't doing it for environmental reasons. It might have been good for the environment, but we were doing it for recycling because all that stuff could be turned into buildings and so forth. And so, as I say, and that didn't change until the late 1960s when the baby boom came of age, and then we just started partying and using credit cards and everything else. So it did change, but it took 30 years to change. In other words, the behavioral and adaptive effects of the depression of the 1930s lingered through the 1960s. And that's my experience, but it's consistent with what these researchers found out. But at the end, when we get to asset allocations, I said, the first thing I do is I explain my methodology and explain what diversification is. Diversification is a very powerful tool. It does what it's supposed to do, which is increases your total return with less risk. But people don't understand how to diversify. I run into people, they say, well, I'm diversified. I own 30 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, you're not diversified. You may have 30 stocks, but you're in one asset class called stocks. So and stocks are hard, they'll go up together. I'm not saying they'll go up together and go down together. So you may have 30 stocks, but you're not diversified. Diversification is, okay, have a slice for stocks, that's fine. Gold, cash, real estate, treasury notes, and alternatives. That is closer to real diversification. So in particular, I recommend about a 10% allocation to gold. And people always want to put words in your mouth. They say, well, Jim Rickards says sell everything and buy gold. I've never said that. I don't believe that. But a 10% allocation, I think, is right. That will, if there is extreme inflation, that will produce gains that are so large, they'll kind of insulate the rest of your portfolio. So you're protected that way. And if there's a loss of confidence in the dollar or some kind of currency collapse, again, gold will do very well. I also recommend 10-year treasury notes, or for the German investor, bonds, 10-year bonds. And the reason for that is, first of all, they're high credit, they're liquid, but interest rates are going to go lower, which produces capital gains. It's a little bit counterintuitive. People don't understand bond math, but it's pretty simple. If interest rates go down, the value goes up. So as interest rates go down, you're getting more capital gains. So we have a lot of, very smart, very prominent people in the United States, Jeff Gundlach, Bill Gross, Dan Isaacson at PIMCO, and others who say, the interest rates are too low. This is the greatest bond market bubble in history. Short the bond market, et cetera. One by one, they've been carried off feet first. They've been wrong about that. And the reason is they confuse real rates and nominal rates. So nominal rates, that's the rate you see on television or when you look at a screen. That's the nominal rate. But the real rate is the nominal rate minus inflation. And the problem is nominal rates are low. That's true, but real rates are not low. I borrowed money in 1980 at 13%. That was my first mortgage. My mother cried because her first mortgage was 2%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%. So my real rate was -2. Plus taxes were 50%, 50, and my interest was tax deductible. So I got a tax benefit on the money I was paying of 50% on the 13%. So that's another 7%, 7.5%. So my after-tax rate, after inflation, after taxes, my real rate was -8. So I was borrowing at 13 nominally, but my real rate after taxes and inflation was -8. That's a low real rate. But the point is that that's where we have to get to. If you want to stimulate the economy and borrowing and lending and spending and investment, et cetera, you have to get real rates much lower than they are right now. Well, we're not getting inflation. And eventually we may, down the road we may, but not now. Deflation is a greater danger. So if inflation is declining, we're getting disinflation and deflation, and the nominal rate is here. How low does the nominal rate have to go to get to a negative real rate? Well, it's got to go negative. It's got to go maybe -2 or -3. That will produce enormous capital gains for the bondholders. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecasts, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, it's gone from, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%, and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's subjective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid 2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off, and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil. And, you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing. And that's still the case today. So, of course, prices went up and, people were trying to pay whatever they had to get what they needed. And energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically, consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side. But by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons. It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly. And so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed balks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and shutting down the Keystone Pipeline,
welfare,
and all that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, kind of looks like the global financial crisis, and hope it doesn't. And there's a difference between extreme recession and financial crisis. They're two different things, but they can happen at the same time as did happen in 2008.
In this video, Jim Rickards talks about the challenges and potential risks faced by the Federal Reserve in managing the economy. The central theme revolves around the delicate balance that the Fed must strike between preventing a stock market crash and avoiding a severe recession. Jim raises concerns about the Fed's ability to have perfect information, citing flawed models and the possibility of being behind the curve in recognizing economic challenges. The distinction between a recession and a financial crisis is highlighted, with historical examples used to illustrate that these two phenomena can occur independently. Jim Rickards emphasizes the difficulty the Fed might face in choosing between preventing a financial crisis or accepting a recession as a trade-off. The reference to Paul Volcker's actions in the 1980s adds historical context, showcasing a deliberate choice to induce a severe recession for the purpose of combating inflation. However, Jim Rickards notes that the current economic landscape is more intricate, with additional considerations such as systemic risks and the potential for a recession triggering a financial crisis. In conclusion, Jim Rickards underscores the complex decisions the Federal Reserve must make, acknowledging the uncertainties and trade-offs inherent in steering the economy and avoiding undesirable outcomes. Before we get into the video, can you help me to give that like button a little touch? All right, let's get into it.
Would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes, but the problem is it might happen anyway. In other words, they might have gone too far, and this almost happened in 2018, and that was my point. It was that by the time they realized their mistake, it might already be too late. So that's one danger, which if they had perfect information, oh, gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
behind the curve.
They could crash the car before they knew it was out of control. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2000 and 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. So the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. You know, we learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Oh, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit. And I granted that. I said, you're absolutely right. It's a nice job. You're a stronger bank now than you were then. But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off. But if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was at the time the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020 since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. Commercial banks, no one really cared about investment banks. They could fail. So what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So there are two possible major blunders here. But again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, it's kind of Scylla and Charybdis, take your pick. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
In the face of these complexities, our discussion leaves us with three potential scenarios: the risk of unwittingly tightening into a recession, the prospect of accepting a recession for inflation control, or the challenging choice of allowing inflation to run rampant. The Federal Reserve stands at a crossroads, and the decisions they make in the coming months may well shape the economic landscape for years to come. As we conclude our exploration, it becomes clear that the path ahead is fraught with challenges and decision-making. The balancing act between preventing a stock market crash and avoiding an unintentional recession places the Federal Reserve in a formidable position. The lessons from 2018 serve as a stark reminder that perfect information eludes them, and the consequences of their decisions may only become apparent once it's too late to correct. The historical perspective sheds light on the dual nature of economic downturns, where financial crises and recessions don't always go hand in hand. Drawing parallels to Paul Volcker's bold strategy in the 1980s, we ponder whether the Fed might consider accepting a recession as a necessary sacrifice for taming inflation.
The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second. Yesterday, GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. When wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they've done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you had a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low. Like, they spent the savings they had, they didn't make new savings, and then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and we'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards, and they're just backing away. And it's showing up in things like gasoline consumption. It's way down. The demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is another. That sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. The fourth quarter could be a disaster. The stock market's starting to wake up to that fact. So I would say it's a pretty simple recommendation, Matt. Reduce your exposure to stocks overall. Increase your exposure to cash. It'll give you, you won't lose money on cash, assuming that inflation is not bad, and it'll give you a lot of optionality. You can go, if things get really, really, really bad, if you have cash, you can go shopping and find some bargains. But if you're in stocks and they go bad, you're just going to lose that money and never see it again. But if you do have stocks or some stocks, I would look at energy, defense, not for good reasons, there's enough wars going on, but defense will do well, and mining because gold and silver prices and strategic minerals will do well. So defense, mining, and energy are the sectors I'd be in. I'd lighten up on tech, get out of everything else, go to cash. Treasury notes look attractive here because interest rates are going to start to come down. I know they've been going up. I get it. But it looks like they peaked and have turned around. So Treasury notes, a good 2-year note, a 5-year note, will perform very well. And they're very safe, obviously. And just take it from there. But you've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. Right. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. The interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. And 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I said, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%. Not quite 5.5%, but well, between 5.25% and 5.5% for 6 month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good, but if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to have a capital loss on the note itself. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note, because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. And what it means is that, so interest rates come down a certain amount, 25 basis points, 50 basis points, or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is, the longer the maturity, the more they go up. They're more volatile. And so the 2-year note's a really attractive piece of paper, very safe. You get your money back, liquid, you can get out of it, etc. The only reason not to buy would be if you thought rates are going to go up. I don't. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back. But from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too.